Hi, I'm Chris Levy, technical partner at Aquila Super. And so next up in our never-ending quest to make your auditing life more, more sort of pain-free and go more smoothly, I'm just going to briefly cover creditors, which is not sort of something that a lot of accountants would think would create compliance issues, but look, they absolutely can. And I guess it sort of comes from many accountants don't really think too deeply about when they're posting various transactions to creditors, yeah, it can actually cause delays and cause problems. So look, before I get into the scenarios that are problematic, it's probably just worth talking about the ATO's position on creditors, and I guess that the danger is that a creditor in the eyes of the ATO is actually not a creditor, it's actually borrowing. So the ATO have actually, they put out a ruling, not surprisingly, in 2009, the ruling's 2009/2, and it talks about the meaning of borrowing. And it's quite broad. There's only two aspects that that are necessary for it to be a borrowing. It's a temporary transfer of money from one party to another, and the inclusion of money is important, but also an obligation on the part of the borrower to repay the money, and that's it. Like there's no requirement for a loan agreement. There's no requirement that there be interest paid or an understanding that some sort of interest will be paid for the transfer of money. It's just that's it. And if you think about it, so step back and have a good think about it. I mean, it can pretty much capture any of these sort of transactions, which is a bit unusual, because they also, in my experience, when I was doing some litigation work, the definition of a borrowing in general common usage does actually require an intention to pay interest, or the presence of interest doesn't exist here. This is the ATO. That's the position they've taken. Now, so fortunately, they have actually identified some things that are, something that you might think might be borrowing, but or fallen into that definition, which they've explicitly said are not borrowings. And they include things like contributions that the fund has received and is yet to allocate. But it also conclude what I'm going to be talking about now, the first sort of scenario, and it's expenses that the SMSF trustees have, they've paid for on behalf of the fund for whatever reason, and they're yet to be reimbursed, and that's acceptable. The ATO ruling states that's fine. However, they've got the line, and it says, expenses paid on behalf of the fund where reimbursement is immediately sought, and that's important. Now, look, in most instances, it's not an issue. There might be expenses from 3-6 months. It's pushing the envelope, and it just happens to fall on 30 June that they're yet to be reimbursed. Look, if it is getting a little bit into those sort of many months, we will raise it in the management letter and say, look, you need to get this sorted. But we have seen instances where the trustees will pay for expenses, say accounting fees, and it just never gets reimbursed, and it might stretch back over several years. The one in my mind is where it was a pension fund, and the trustees basically thought, well, we're taking all this money, we're being forced to take this minimum pension out, and liquidity is not as strong as perhaps it should be. We don't want to take any more money out. We don't want to pay the accounting fees out of the fund. So the accountant just basically said, "Oh, look, I'm just going to leave it as a creditor," and it built up over many years. That's a problem. And I think that the ATO would almost certainly view that as borrowing. So look, just be careful about that. Now, the second creditor issue I've seen, and I guess it's perhaps not called a creditor, but it's prepaid distributions from unit trusts, or sometimes called overpaid distributions from unit trusts. And the scenario is fairly straightforward. It's unit trusts, and this can include managed funds, big, widely held unit trusts, and smaller 1322C unit trusts, related unit trusts, and also these semi-related trusts, where say only 3 or 4 unit holders. But the scenario is that the trust has surplus money, surplus cash, and But for whatever reason, the accounting profit and the tax profit are different, so that it can't be distributed, back to the investors as profit, as distribution. And so essentially, it's, look, we've got the surplus money, we're handing it back to you. It's effectively handing the investors' capital back to the super fund and all of the investors. Now, look, again, the ATO have a position on distributions from unit trusts and unit trusts generally, but they don't talk about this scenario, and so we sort of have to fall back onto the creditor ruling. Now, again, most accountants tend to put this overpaid transaction, or sorry, prepaid distributions or capital coming back into the creditors area, the liability section in some capacity. And look, I mean, if all of the investors have been treated equally, there is an argument. So look, this is actually quite arm's length. It's quite commercial, but we've seen instances where it's created problems. And look, the sort of things that can, the factors that come into play and as to whether it could be an issue. Look, I've heard instances where between the unit trust and the fund, there's a loan agreement or there's interest being paid on that sort of prepaid distribution. That causes a problem. That's making it sort of look like the character of a loan and create borrowing issues. But it's very rare. I'm yet to see it myself. I guess the other factor as well is, is it actually proportional? Is the repayment, or sorry, the prepayment proportional between, say, the super fund and other investors, which may include, family trusts that are related to the members. So you've got to sort of factor that in as well. But I guess the most significant area, and the one that applies to most of these prepaid distributions, is, well, look, how is it being treated both in the super fund financials, but even more importantly, in the unit trust financials? We had a very simple scenario where, again, it was a property development type scenario in a unit trust with multiple investors, I think about 4 to 6. And they, for whatever reason, the development was winding down. They didn't need as much money, so they handed some back to the investors. And it all looked fine. There was no mischief involved. But because in the unit trust financials, they called it a loan, the ATO said it was a borrowing, and they would not budge. There was correspondence between the unit trust management and the various investors outlining what it was, that it was capital in nature. But because I suspect a junior accountant had classed it as a loan in the unit trust financials, the ATO said, no, it's a borrowing, full stop, and they would not budge. So if you have one of these situations, try and sort of dot the I's as best you can. Don't call it a loan. Call it a prepaid distribution or a capital repaid or something like that, but don't call it a loan. And even better, actually have a minute or some sort of correspondence from the trustees of the unit trust outlining what's going on. And I mean, the ATO put a decent amount of stock in that kind of correspondence because it sort of outlines the intentions of the unit trust management, and it can shift the character of it, I guess, away from being a loan and actually being sort of, it's more of just a repayment of capital that's happened earlier. So yeah, look, I mean, that's basically it. Those are the key sort of two issues we have for creditors. Hopefully it's been of use to you to make your SMSF audits go smoother. And look, should you have any questions about this or other matters, please feel comfortable reaching out to myself or the other audit partners at Aquila. Thank you very much.